We continue with our discussions on Financial Management Unit 2. In this particular video, we're going to talk about another way of valuing stocks, which is commonly known as relative valuations. Right now, what is relative valuation? As the name suggests, we will have to value a company or a stock, common stock or security, using relative valuations of other similar securities in the market. Right now, there are a couple of interesting things that come out of here. We have to look at other securities and compare to them, try and find what is the value of a company. So this will always be relative. Right? So far what we had done was primarily absolute in nature. What do we mean by absolute in nature? Absolute is essentially independent. So we were just finding what is the stock price of a particular company. We were not really looking at what should be the stock price when you compare it to something else, right? Now we are comparing it to other entities, and that's why the first part comes in. The second one is similar securities. What do we mean by similar? So when we say securities are similar, they should be similar in nature, which is essentially whether you're saying they are stocks or bonds. You can't compare a stock to a bond or a bond to a stock, right? So you have to compare stocks to stocks. The underlying company's industry should be same. You cannot compare a steel company to an airline company, and you cannot compare an airline company to a software company, because the underlying dynamics and risk reward perspectives are different for these sectors. When you say similar, companies should be similar in size as well. So you have to compare a large company with a large company and a small company with a small company. You cannot compare a small company of 10 crore revenue with a large company of 10,000 crore revenue, because there would be differences in terms of how the market views these companies or what is the risk of these companies. In other words, you could combine these and say that the companies need to have similar risks that they are taking. Risks in terms of the business, risks in terms of the size, risks in terms of the nature of the security that you're looking at. All of these need to be similar, and then you could apply what is commonly known as relative valuations, right? Now, we will not get into too much detail about a variety of relative valuation parameters, but we'll focus our attention on one specific way of trying to arrive at the company's price or value, right? So let's understand. It's a technique in which we value an asset based on the valuation of similar assets in the market. The key here is find comparable firms, right? Which is what we said, similar firms, similar in size, similar in industry, similar in whatever they do, basically on the context of risk parameters, right? Then you standardize the data, which is essentially saying that you have to use uniform data. We'll explain this using examples, that when you use uniform data, what does that mean, right? And then if there are any such other differences which are subjective in nature, you adjust for them, right? For example, they could be in the same business, but one company is export driven while the other company is domestic market driven, right? So one company sells in India, the other company sells outside India. Right now, this could have implications in terms of what is happening in the global economy. So if US slows down or US economy slows down, it has an impact on the first company, but does not have an impact on the second company, right? So the risks, depending on what is happening in the market, could be different for different companies, and you may want to subjectively adjust for that. Now, in the context of our discussion, we are only going to use at this stage the first two. Right, we are not going to use the adjust for differences at this stage. That's because under financial management, most of the work that we do under relative valuation is going to be fairly simple in nature. The objective is purely to arrive at sort of a stock price. The objective is not to get detailed into using relative valuation as the only valuation tool. Some part of this in detail will come when we reach the second stage in some of the subsequent semesters, where we're going to study equity valuations separately, right? So that's relative valuation. Now, on a more conceptual level, relative valuation is in sync or in line with what we keep doing all the while. Now, we keep comparing stuff that we feel is similar. That goes on in our brain all the time at the back end, right? Examples, we will look at, if you're buying a shoe, we'll keep comparing whether one shoe is better than the other. If we are flying in an aircraft, we'll see whether we fly Indigo or Jet Airways. Now, essentially, what we are trying to ascertain is if we are paying some money for purchasing something, where are we getting more value for our money? Right? So it's a concept of, relatively speaking, which asset or which instrument gives me more value, right? That's where relative valuation becomes important. And it's in a sense, if you go to buy a shoe and you know the pricing of a similar shoe in the market, then you have a base price to understand, saying that okay, I should be paying about this much, roughly this much for the shoe, right? That's the same principle that we are extending in terms of our understanding on valuation of stocks, right? Now, let's understand the most common and widely used metric under relative valuations globally. This is something called as the price to earnings ratio, commonly referred to as PE ratio. Right? Now, how do we find the PE ratio? This is nothing but the share price of the company divided by earnings per share of the company. Right? Now, let's first conceptually understand this, and then we will revert the equation to arrive at the share price of the company. Right? What is the share price of the company? Whatever every share of the company is trading at is given as the share price. How do we find earnings per share? Right now, earnings per share is nothing but also known as EPS, short form for earnings per share. And this is nothing but you take the total net profit of the company, final profit, which is also known as earnings of the company, and you divide it by the number of shares. In other words, if you're holding one share of the company, what is the entitlement of earning that you have because of that one share of the company? That is what is called as the earnings per share concept. Right now, that essentially defines what is the profitability that is being shared with each shareholder that holds one share. Now, the company may choose to give this or not give this. That's a different issue. They may choose to give a dividend, they may choose to not give a dividend. But technically speaking, if you have a company whose net profit is 100 crore, rupees 100 crore, and you have 20 crore shareholders, then for every share that you hold, you are entitled to rupees 5 per share. Correct? So if you have earnings per share coming as that, now on this earnings per share, whatever the share price of the company is, that gives you or defines the PE ratio. So let's say the share price of the company is 60 rupees and earnings per share is 5. We are talking about a price to earnings ratio of 12. Now, how does this become important? We'll come to that in a moment. But essentially, that's how the price to earnings ratio is calculated for any company, right? Now, let's try and quickly look at this. If a company's share price is 200 total net profit is 10 crore and the number of shares outstanding is 1 crore, calculate the PE ratio, right? So in our equation, we have to first find EPS or earnings per share. What is earnings per share? Total profit of, that's net profit by number of shares. That's 10 crore divided by 1 crore, so that's 10. Now we come back to this equation. It says share price of the company, which is 200 divided by 10, which is the EPS, earnings per share, and that gives you a value of the PE ratio of 20. So this number is 20 for the company. Now let's actually extend this analysis and try and understand what do we interpret with this 20. What does this 20 actually mean, right? Now it's a very simple ratio and that's why it's widely and inherently used. It captures the price you are paying for every rupee worth of earnings in the company. So if you look at it in our previous example, what we were doing was that for every rupee worth of earnings in the company, earnings entitlement in the company, right? I was paying 20 rupees. So for 10 rupees, I was paying 200, right? That's what was happening. For 10 rupees, I was paying 200, which means for every rupee worth of earnings entitlement in the company, I'm paying 20 rupees. That's the PE ratio. If the PE ratio is 12, for every rupee, I am paying 12 rupees. For 5 rupees, I'm paying 60 rupees, which means for every rupee, I'm paying 12 rupees, right? Now, then it becomes a benchmark for comparison. Now, all other things being equal, if you're saying PE ratio of a company is 10 and another company is 5, then in the first case, for rupees 1, you're pay 10. In the second case, for the same rupee 1, you are paying 5. Now, all other things being equal, which is more relevant, which is better? When we pay lesser for the same entitlement, right? So in the case, earnings are the same, as in rupee 1 is going to be the same in company A and company B. Whether you invest in company A or you invest in company B, if you're going to get rupee 1 only, then it is better for you to invest where you have to pay less, right? So obviously paying rupees 5 is more attractive and hence the stock is said to be cheaper. Company B is more is undervalued as compared to company A because you're paying lesser for the same rupee 1 of earning in the company, right? So that's the inherent understanding that if the share price is 300 and earnings per share is 15, the P ratio works to 20, which again means that you're paying rupees 20 for every 1 rupee worth of earnings in the company, right? When you buy a share, you're entitled to this 15 rupees, and for buying that share, you're paying 300, which means for every rupee of earning, you're paying 20 rupees to the company, right? To the shareholder of the company who's giving you this share, right? So that's how you calculate the price to earnings ratio. Now there's another way to calculate the price to earnings ratio, and we'll introduce another term at this point of time, which is essentially, if you look at the calculation of the formula, that's the formula share price of the company by earnings per share of the company. Let's actually take the share price and let's take earnings per share and multiply this with number of shares of the company and divide this by number of shares. We can do this mathematically. The impact will be the same. So that's what we do here. Share price into number of shares and earnings per share into number of shares. Now remember, how did we calculate EPS? EPS was calculated as net profit divided by number of shares. So when you multiply EPS with number of shares, that's what is happening in the denominator here. That gives you the net profit of the company, right? In the numerator, we introduce a new term, which is the total number of shares outstanding of the company multiplied by the share price of the company is the equity value of the company. That is known as market capitalization of the company, right? So market capitalization of a company is being referred to as total equity value of the company. And what do we mean by total equity value? That's going to come from share price into number of shares. That's the total equity value, right? So effectively, if you have the details about market capitalization also available with you, and you know the company's net profit, you can directly arrive at the price to earnings ratio, right? Let's take an example that will make things clearer. So let's say there is a company whose market cap, I'll use the term market cap for market capitalization, is rupees 2000 crore. Their net profit is rupees, let's say argument's sake, rupees 100 crore, right? And number of shares is, let's say, argument's sake, we say 100 crore again, right? Now, if you think about it, the total value of the company is 2000 crore and the number of shares is 100 crore. What should be the value per share? Right? Total value is 2000 crore. Number of shares is 100 crore. If you buy one share, the actual value or price per share should be 2000 by 100. That's 20. That's going to be equal to the price of a share, right? What is going to be EPS? Earnings per share is going to be 100. That's the total profit divided by 100. So that's going to give you 1. Now, do you calculate PE ratio? That's price per share, which is 20, divided by earnings per share, which is 1, is equals to 20. Calculate it using the second formula, which is market capitalization of the company, which is 2000, divided by net profit of the company, which is 100, which is going to give you 20 as well. So whether you calculate using the earlier formula, which is share price divided by EPS, you get 20. And if you calculate it using this formula, which is market capitalization divided by net profit, you still end up getting the same value. So depending on what data is available with you, what data is given to you, you're calculating the price to earnings ratio of the company, right? That's the straightforward calculation on how do you go about trying to find out the PE ratio of a company. Let's now apply this in our context where we are saying that we're going to use this to value a stock of a company, right? We can turn it around to understand it. To value a company, we need to find similar companies in the market and try and find out what they are trading at or valued at, right? So for example, if we are valuing the firm Infosys, right, which is a large software company of India, we have to find the similar large software company in India, for example, TCS, Tata Consultancy Services, right? Now, we get from the market from somewhere that PE ratio of TCS is 20, right? How do you calculate it? You look at TCS share price and divide it by earnings per share. In other words, you can look at TCS market capitalization and divide this by TCS net profit, right? Let's say we are given this data. At a later stage, we'll also try and find out how do we get this data. But at this stage, let's assume we are given this data, right? Now, once we have this data, we'll get TCS PE ratio. Once we have this data, which is, let's say 20 is the PE ratio, we are saying earnings per share of Infosys is 55. What is the fair value of the Infosys stock price based on relative valuation? Now, because these are similar companies, they should trade at similar values, right? So for 1 rupee of earning, if you're paying 20 rupees in TCS, there is no reason why you should be paying significantly different in Infosys. So Infosys should also trade at a PE of 20, right? Now we were saying PE is equals to price of the share divided by earnings per share, right? In this case, it means that price should be equal to the PE ratio multiplied by earnings per share. What is the earnings per share for Infosys? That is 55. What is the expected PE ratio? It should trade at a PE of 20. That's 20. So the share price of Infosys should be 1100. Right? That's how we arrive at the value or price of a particular stock of a company based on essentially what is a relative valuation that you're giving to another company in the market, right? So that's essentially where relative valuation becomes important. Let's try and calculate it another way, right? We are saying that uh, the net profit of a company is 100 crore, Ratan Steel. Second example. So we have net profit as 100 crore, right? Shares outstanding are 10 crore. So total shares is 10 crore, right? What is EPS? 100 by 10. So we get EPS as 100 divided by 10, which is rupees 10 per share, right? Per share price, right? So price of the share is given as 171. Price to earnings ratio will be 171 divided by the EPS 10, which is going to be 17.1, right? That's another example on how do you calculate what is the price to earnings ratio. Now, if there is another steel company, let's say there is another steel company which is of a similar size and scale and has an EPS of rupees, let's say 2. What should be the price of the stock? So price should be PE ratio into EPS. PE ratio we are saying is 17.1, EPS we are saying is 2. So this should work out to 34.2. The fair value of the stock as per our understanding of relative valuation should be rupees 34.2. If it is at 34.2, it is valued fairly. So that in a nutshell is broadly how we are going to use the concept of price to earnings ratio to find out the value of a company. You find a similar firm, you find what is the PE ratio of that firm, and then you essentially extend this analysis and say your company under question should trade at the same PE ratio, and you multiply the PE ratio with the earnings per share of your company to arrive at the expected price per share, right? That's the calculation that we're working with. That's how relative valuation works. Remember, unlike absolute analysis where only cash flows of that company were needed, here you need the profit and value of another company in the market. Only then can you extend this analysis in terms of understanding how this goes. As we close this, one final note, one of the other places where something like this becomes important is, let's say if a company is buying a project or another company, right? Now, you don't necessarily know, you can do it two ways. Either you can go and find out the cash flows of the project or the company and do a discounted cash flow valuation, which is what we learned earlier, or you could find out if there have been similar transactions, right? Let's say a company wants to buy a hospital. Has there been another transaction on another hospital in the past? If there has been a similar transaction, what was the price to earnings ratio that was paid in that transaction? And if that is correct, then the same needs to be applied. If your company or project under question are similar, apply the same. This is also an extension of relative valuation where you're using a similar priced asset in the market, similar priced project in the market, and trying to ascertain what you are going to pay for that particular project or company, right? That's it in relative valuation. That is how we go about doing valuation of a common stock or valuation of a bond, we have primarily seen two methods. One is the discounted cash flow methods, where you have a series of cash flows and you are trying to kind of discount those at the expected rate of return, right? The other one was relative valuation, which is commonly used in only stocks, where you're finding similar companies and you're trying to find out what is the value of your company based on what is the value of those similar companies, right? So those are the two broad methods that we saw in terms of our valuation exercise on let's say bonds and stocks, right? We extend this principle in terms of further concepts now in trying to find out if we are going to use DCF, then what is going to be the expected rate of return. A large chunk of what will follow for us is going to focus on this expected rate of return from a particular company or its stock or its bond, depending on its risk reward characteristics, right? All that will follow. That's where we end this particular video. Thank you.